Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and this is Jobs Friday. This is the day we get the report on employment, and this is for the month of May 2022. And we've got the usual cast of characters. We've got Cris DeRides, the deputy chief economist, Ryan Sweet. Ryan is the director of real-time economics, and Marisa DiNatale, who joins us regularly on Jobs Friday. We're missing Dante. Where's Dante, guys?
He's on vacation.
Oh, do you know where he went?
Good for him.
He went far, far away because of ADP.
Ouch. Oh man, ADP was really weak, wasn't it?
It was.
I think ADP, that's the, we put together the data based on ADP payroll records. And that came in at 128,000, something like that.
Mm-hmm.
Yeah.
Mm-hmm.
Okay. That was low because the number was, Marisa, what was the number for the month of May in employment?
The non-farm payroll employment rose 390,000.
390K. That was, okay. So let's just dive right in. So what do you think? Want to give us a sense of the report?
Yeah, it was another very good one. Job growth slowed from what we've seen in previous months, but as I just said, rose 390,000 in May, which was well above, I think, what most people were expecting. For the first time in a while, the revisions to the two prior months were actually negative combined. So the estimate for April was revised down by 30,000 jobs. So instead of a 428,000 gain, we got a 398,000 gain. And the change for April was revised up a little bit by 8,000. So combined, March and April were 22,000 lower than they were previously reported. So on the payroll side of things, it seemed to be more that a mix of industries adding and subtracting. So we got a very large gain in leisure hospitality, where jobs were up 84,000 in May. We got a very large decline in retail trade. So retail jobs fell by 61,000 in May. We had an increase in construction, which was kind of big compared to the previous months. Like last month, we got no change in April. We got a big increase in professional business services and transportation. So it was a pretty broad-based increase on the payroll side of things.
Education too, right? Right, Ryan?
Yeah, and education in state education payrolls rose as well. Yeah.
Yeah, that government number surprised me. It was really strong.
Yeah,
and that was mostly education.
Correct.
Am I correct? Okay. And we're still down, despite it all, we're still down about 800K from the pre-pandemic peak.
That's right. That's right. So we're almost there. We're about 0.5% below where we were prior to the pandemic.
Okay. So before you move on, so what is underlying job growth? Abstracting from the vagaries of the data, what do you think it is? Monthly job growth?
Well, I think it's weakened a bit in the past few months. We've seen some cooling off in the pace of job growth. It looks like it's about 400,000, 400 above, a little above 400,000. It's been about 500,000, right? Until the past several months. So yeah, if you just look at moving averages, it looks to be a little bit above 400,000.
Right.
Which is incredibly strong still.
Yeah. Yeah. But it's down. I mean, I think the average monthly job growth in take the past 3 months, it's about 400K. Take the preceding 12 months, that was 560K. So that's boom-like. So it's still boomy, but not nearly as boom. What should I say there? Boominess as it was.
It's less
before.
boomy.
Less boomy. That's the right way of saying it. Less boomy. Yeah. Hey, anything in the retail numbers? What is that? Is that seasonals, or are we just going back to pre-pandemic retail brick and mortar?
I wanted to talk about that maybe. I mean, I'm sure Ryan has some thoughts on that.
If you look at not seasonally adjusted, it also fell.
What fell?
It's unusual. It normally rises in May, but it fell. So this is a really bizarre number.
Yeah, maybe we can get into it a little more, but
Well-
it's the first time the not seasonally adjusted retail number fell in a May since the 1960s.
Well,
Yep.
maybe that's just the normalization in spending patterns, right? We're
Yeah, it
stopping-
could just
Yeah.
be that spending was pulled forward and things just aren't happening in their usual.
So in the pandemic,
they're
we stayed
shifting,
home.
right?
We stayed
Yeah.
at home. We bought stuff, goods, things.
Mhm.
And now that we're reopened and traveling, we're buying less stuff. So you would expect those retailers like building material and supply stores. I didn't look at it. I'm guessing was that down?
down.
Yeah,
Yeah.
that would be consistent with that, right?
Mhm.
That
But
people are,
yeah, half the decline was in like the big box stores like
Okay.
Costco's and Targets and stuff like that. That was almost 30,000 of the 60,000 decline in retail.
right. Okay.
And Target and Walmart reported on their quarterly earnings that they're
Hmm.
seeing shifts in patterns, that they have more inventory on the shelves than they had expected. So it's consistent with that
Shifting back in
uh,
spending behavior.
Yeah.
Yeah, you're going to start to see this in the retail sales numbers. They're going to start to be really, really weak, but that only tells, a third of the story. Real services spending is picking up.
Well, also you saw in today's numbers, I don't know if you mentioned it, Marissa, but transportation, warehousing employment increased a lot, I think,
Yeah.
didn't it?
Yeah,
Right.
and a lot of it was trucking.
Trucking. Okay.
Mhm.
Okay, good. All right. I stopped you. You were talking about one aspect of the data today. That was the non-farm payroll data, based on the survey of businesses. We also got data based on the survey of households. So what did that have to say?
So the big headline number, the unemployment rate, stayed at 3.6% for the third month in a row. And if you go out 3 decimal places and you look at the unrounded number, it fell a tiny bit. Both the labor force participation rate and the employment population ratio ticked up by 1/10 of a percentage point. Let's see what else. The number of people, this was sort of interesting. I don't want to make too big a deal out of it, but the number of people working part-time for economic reasons rose. And it was all people saying that their hours were cut back by their employer
Oh.
because there wasn't enough work to do.
Missed
Not
that.
the other piece of that could be that people were looking for full-time jobs, but they could only find part-time jobs. It wasn't that. It was hours cut back.
What about hours? I didn't look at hours per weekly hours. Did they get, what happened to those?
I
To
think
that.
they were, let's see.
Do you know, Ryan?
They're unchanged.
Unchanged? Okay.
Yeah, I think it was 34.6.
Because that would be a leading indicator of weaker job growth dead ahead. Businesses pull back on hours before they cut jobs, but
Right.
not
Yeah.
in this report. Okay.
And average hourly earnings rose 10 cents over the month. They were up. Do you know what the percentage?
5.2, 5.2.
Yeah, year over year,
That was
Yeah.
year over year. Yeah.
0.3% month
Month
over
over
month.
month, 0.3.
It's moderating though, don't you think? Wage growth?
But yeah, but because of the composition of job growth this month, I wouldn't put
Oh, okay.
tons of stock in that moderation.
But it feels like even accounting for the mix effects, this thing's going to roll over on a year-over-year basis, right? Just the base effects, because we're now getting to a place where we had pretty strong wage growth a year ago, so it feels like it's going to
Right.
start to come in.
I
Yeah,
think the employment cost index is right around 5.
Yeah, it's around 5
it
too.
is. Yeah,
Yeah.
they're all pretty consistent with each
Yeah.
other.
And the employment cost index controls for the mix of jobs, for what's going on across industries and occupations. So that's the higher quality quarterly series, because it takes a while to construct it. This data we're talking about, the average hourly earnings, is coming out of the monthly jobs numbers, but they're consistent now, roughly.
Right.
consistent.
Yeah.
Okay. Anything else you want to call out in the report, Marissa?
I don't.
I noticed you
Oh.
didn't mention participation. I don't think that picked up a little bit, but
I
you know
did, yeah.
what I found interesting is labor force growth, which is, participation times working age population. That's growing very strongly, well over 2% year over year. And that's about as strong as it gets. I mean, typically it's well below 1. So that feels like we're getting some bump from higher participation, but also feels like working age population growth is kicking back, and maybe that's immigration. I don't know. But I thought that was, so it's not only about job growth slowing, it's also about labor supply growth
Mhm.
accelerating. And both those things are, positive in the context of a tight labor market and the high inflation. We want to get inflation down.
Right.
Okay. Ryan, anything to add? You want to fill in any holes or add any color to what Marisa had to say?
Well, the prime age employment to population ratio.
Oh, yeah.
25 to 54 ticked
Uh-huh.
up from 79.9% to 80%.
Okay.
There's still room for improvement, but we're headed in the right direction. Kind of the idea of, are we at full employment yet? Probably not, because that could go a little bit higher. I think the number is overall a little bit misleading. The seasonal adjustment factor was very, very favorable in May, a lot less or a lot more favorable than in past May. So
Favorable
getting
to
back to
what?
Mercer,
To participation or?
to
No.
overall job growth. I'm sorry.
Oh, overall.
I think
job
what we're
growth.
going to see is, continued downward revisions, particularly since the response rate was really, really low, and it continues to remain low for the first print. So, it's close, but it's, we know these numbers aren't 100% accurate on the first print. So
What was the response rate?
I can look it up. I think it was in the
I think,
60s.
I think the whole world has survey fatigue. I'm
It
just
does.
telling you. I think people are just tired of surveys. I mean, I'm like, I get on a flight, I get off the flight. How do we do?
Yeah. Yeah.
I just like, I'm burnt out. I think we have our own survey of our employees. How are you feeling? The so-called BES survey. What does that stand for again?
Business effectiveness survey.
Business effectiveness survey. And I think our survey responses are, well, last I looked, they're pretty low. I think just people are just burnt out, from all these surveys, which has all kinds of implications, doesn't it? For the data.
Yeah, for the accuracy. Right.
Yeah. I wonder what
I
that
mean,
means.
the good news is that, with each subsequent report, the response rate is increasing. So, by the third revision, the response rate is over 90% for the employment data.
Oh, is that right? It is over
Mhm.
90%. Okay.
Yep.
So the revisions take on added importance, right? Because we're getting a lot more
Correct.
data. Yeah. Okay.
Mhm.
Okay. Very good. Cris, anything to add on the job numbers? I know you look into the bowels of this too.
Not really. I think Marissa and Ryan covered it well. Overall, pretty strong report. Hard to find. The retail was the one that kind of stuck out as the point of weakness, but construction was up. That was perhaps one thing to note. We now have construction well above what it was in February of 2020. So, just points to, again, some strength of that industry, at least for the short term here. So.
All right.
The next few months.
sorry,
aren't
go
gonna be, I was going to say that, we likely aren't capturing the full impact of the recent weakness in residential investment. Like housing starts are down,
Right.
mortgage rates are up. So construction is going to start to soften.
That's right. So short term, it looked like, or historically, it looked like some activity, but
Yeah. So broad strokes. This is how I characterize the message in the jobs numbers. I'm curious. You agree, disagree? That the job market is strong. 400K per month is strong job market, but it's slowing, moderating, and that's great. We need that because the economy, the job market's been too strong in the sense that we're going to blow past full employment here. Unemployment's going to decline. We're going to go past full employment, which is going to exacerbate wage and price pressures. Exactly what we don't need. We got to get inflation down. So we need the job market to slow. In fact, by my calculation, we need to get back down to something like 150K at most per month to be consistent with labor force growth and make sure that unemployment stabilizes so that we don't blow past full employment. And it feels like that's where we're headed here. And at the same time, we are getting some improvement in labor supply. Good growth in labor supply is improving. And wage growth still strong, but moderating. So when I look at this report, it feels pretty good to me. If I were writing the numbers I would want, if I were king on the piece of paper, it's not exactly what I want, but it's pretty darn close, within spitting distance of what I would put on a piece of paper. What do you think? Anyone agree, disagree with that characterization of the report?
I agree.
You agree? Okay, Marissa
Yeah.
agrees.
Yeah.
I
think
don't care what
the
you
Fed
guys
would
say. If
agree.
Marissa agrees, I'm good. So
Yeah,
we'll
I
just
think the
stop
Fed
right
would
there.
agree with you too.
You do think the Fed would agree with me?
Yeah, this is what they
Yeah.
want. They want things to slow down.
So is it slowing down enough though?
Yeah.
Sounds like you're saying yes. That
Well, I
this
think they
doesn't
want to
change their
gradually. You don't
monetary
want
policy.
I don't think you want a sudden decelerate, like an abrupt one. I think they want it to occur over a few months and then settle down into a sustainable pace.
So Marissa likes it. Ryan, you like it.
Mm-hmm.
You think you're the Fed whisperer, and your Fed
Yeah, this is what they
whispering
want.
suggests they like it.
Mm-hmm.
Chris, what do you think?
I like it. Yeah, definitely.
like it.
There's nothing.
The stock market and bond market didn't quite like it. I mean, it wasn't a big sell off, and
They didn't hate it.
They didn't hate it. But bond yields, long-term bond yields, 10-year treasury yields have risen back 5-6 basis points. Not a lot, in the grand scheme of things.
But I think we're in that awkward period where good news is bad news, in the sense that, it was stronger than expected. It was a solid employment report, which means the Fed might not pause in September. And I think that's what you're getting a reaction in the bond market and the stock market about.
Oh, you think bond investors were anticipating a pause in September?
Yeah, they strongly hinted at a pause. And then yesterday you saw yields go up a lot. And that was because Fed Governor Brainerd, said it's going to be a hard case to make for a pause in September. So it doesn't mean 50 basis points in September, but maybe they dial back down to 25. But I think if you look at Fed funds futures, they were starting to price in a pause.
Right. Okay. I want to go to the statistics game very shortly, but one other thing I want to talk about before we get to the statistics game is I'm getting a little confused about the actual strength of the economy. We've been talking about the job market, the jobs data. It says the economy is strong, right? If you create 400,000 jobs a month, when that typically it's 150, maybe 100, that's a strong job market. Unemployment is low, 3.6%. The employment to population ratio for working age workers, 80%. That's a strong economy. But then I look at the GDP numbers and I go, well, what the heck's going on? So GDP, that's the value of all the things that we produce, which was kind of the headline number, what economists look at to gauge, well, how's the economy doing? Well, they talk about GDP and then they talk about jobs. But they talk about GDP declined in the first quarter of this year. It's quarterly data. And if you look at our tracking estimate that you put together, Ryan, for the second quarter, that tracking estimate is based on all the monthly data that's coming in. And based on that, we make an estimate of what we think GDP will be in the current quarter, the second quarter. It's now only 1.5%, positive 1.5. It's positive, but it's within spitting distance of negative. And it's not, correct me if I'm wrong, I'm going to stop in a second and ask your opinion, Ryan, of all this. It's very possible we could get a negative GDP print in Q2, which would mean 2 quarters of consecutive negative GDP, which, historically has been kind of sort of it's not accurate, but kind of sort of the rule of thumb for a recession, right? So, Ryan, did I characterize the data yet? What the heck is going on? And how concerned about that? And how do you square all this? Is the economy strong or not?
No, it's really strong. It's
really
fine.
strong.
It's the decline in GDP in the first quarter was a smaller inventory accumulation and a drag from net exports. And net exports were an enormous drag because we're buying a lot of stuff, and a lot of that stuff is imported, and that caused the trade deficit to really widen out a lot in the first quarter. Second quarter GDP, it came down. It was north of 2% earlier this week, but then we got vehicle sales, and vehicle sales really softened in May. So that kind of dinged GDP a little bit. But again, when you look at the domestic economy, so if you strip out inventories and you strip out net exports, growth is still pretty solid.
Okay, so you're saying ignore the GDP number.
Correct.
That is not representative of the health of the economy.
Yeah, one thing I do every quarter when GDP comes out is look at the contribution to like the volatility in GDP, and inventories and net exports are really climbing. So they're kind of causing the data to be a little bit fuzzier than normal.
Well, you could take a kind of a darker perspective on that, right? On the inventory side. I mean, we had Gene Soroka, who's the executive director of the LA ports on, and he made the point that in the surrounding LA basin, there's more warehouse space than anywhere on the planet. And those warehouses are packed to the gills with stuff. Inventories are very, very heavy. We're overladen with inventory, at least based on that. And that would suggest that would mean that producers, manufacturers are going to have to cut back at some point, that, they've
Correct.
done too much and we're going to cut back. And that's a negative for the economy. That's why you get declines in GDP, less output. You're not worried about that, or you are?
No,
worried?
I am worried about it.
Okay.
I mean, if you go back several podcasts, probably this time last year, we were talking about, risks to the economy this year. And we all talked about inventories. Cris brought up the cobweb theorem and you heard on the podcast about with the head of the port of LA, he mentioned that businesses over ordered. They, double, triple booked. So I think inventories will be a drag, but I think the rest of the economy will start to improve. I think trade can't subtract this much from GDP going forward, because just like in the retail sales or the retail employment numbers, the mix of spending is shifting away from stuff to services, and that's going to help narrow the trade deficit.
Yeah, he said inventory management has gone from just in time to just in case. So
Right.
hold excess inventory. But the inventory situation would suggest that the economy is actually, that argues for softness. Adds to the concern about the economy. Okay, all right.
I kind of wonder if that's going on a bit in the labor market too.
Yeah,
Kind of employers panicking that they're not going to be able to find people and hiring and holding on to people, and then having to cut back on hours because there isn't actually the work to support that labor. I mean, there's some evidence that that's happening in some segments of the economy.
right. Yeah, and you can see it in the. It feels like you can see it in the close to record number of unfilled job positions. We're still over 11. I think it was 11.4 million unfilled positions, pretty close to record highs. That feels like businesses just, if I'm worried about long run staffing my business, I'm going to keep those unfilled, even though I'm not hiring, I'm going to keep those positions open, out
Yeah.
there, and continue the process of talking to people.
There's
So-
nearly 2 unfilled positions per unemployed worker.
Which
Yeah.
I'm sure is a record high.
Yeah, I mean, it's like double what it usually is. So
Okay, so going back to my question, is the economy strong or economy weak? You're saying the economy's strong, but this inventory situation is a reason for some nervousness about what's going on.
yeah, I think somewhere in between the two. It's not as weak as the GDP numbers would suggest. It's probably not as strong as the labor market would suggest. So it's somewhere in between. I mean,
Chris, what do you?
softening.
He's
Yeah,
buying it back a little bit.
Yeah,
Well, I'm pushing him a little bit, so he's taking a little step back.
he's trash talking.
I'm a little confused by it. That's why I'm asking. Chris, what do you think about all this? Is the economy strong? Is it weak? I mean, depends on which part of the elephant you touch. What's going on? How do you characterize it?
I wouldn't say strong. I'd say the economy is in transition, which is what it sounds like we've all agree on, that we're moving away from goods to more services. The unwinding some of the pandemic effects here, on top of all the supply chain and energy and everything else that's going on. So for that reason, you have all these forces going on. I think you can't characterize the economy as being particularly strong during this period. I don't know that it's collapsing or the GDP is representing the true picture. I think that's overstating the case, but so I would say it's growing. Underlying growth is there, but certainly it's vulnerable to a number of these forces during the transition.
Okay, you're on the National Bureau of Economic Research Business Cycle Dating Committee. This is the group of academic economists that decide whether you're in recession or not. And let's say it's now September, late September of this year, and you just got the number for Q2 GDP. It came in at negative 1.3%. On top of what was it down in Q1? Minus 1.5?
1.5. Yeah.
1.5. Recession? No recession? How would you characterize it?
Labor market is still strong, 3.5, 3.6. Unemployment rate?
Oh yeah. The job market is
sailing along.
Job market is doing what it's doing right now. Yeah, exactly. Sorry. Yeah.
And everything else is kind of hunky dory as well.
Well,
industrial production.
I mean, it depends on, again, where you touch the elephant. In the housing market, is it hunky dory? I'm not sure. I mean, so
it's not collapsing.
You're an equity investor. Is it hunky dory? I'm not sure. Okay, but you characterize it the way you want to characterize it. But what do you
Yeah,
think?
I would say if GDP is negative solely because of the inventories and trade, but everything else is looks relatively positive. I'm not going to call recession quite yet.
Yeah.
You can't. A recession is a broad-based decline in economic activity.
Right.
And if it's just
Broad-based,
inventory,
persistent decline.
Yeah.
Economic. Okay. Okay. Just saying. But I'm not even sure that's the right words, but those are my words. Marissa, if you're on the business cycle dating committee of the NBER, 2 quarters of negative GDP, what do you say? No.
I'm with Chris. I think
Yeah.
as long as other components of GDP, like what is consumption doing and investment and how's the job market doing? And yeah, how are asset prices doing, particularly housing? We're all expecting some sort of correction or cooling off in the housing market, which is warranted given what we saw over the past few years. I think the labor market and spending growth would count a lot more to me than just looking at inventories or trade.
Yeah. Okay.
What about you,
I
Mark?
agree.
You
Yeah,
agree?
no, I definitely, I would agree with that. I mean, I don't think you can call a recession with job growth. I mean, the
Right.
economy's creating
that's-
jobs.
It's
How
tough.
can that be a recession? I mean, it
Right.
doesn't make any sense. With low unemployment, 3.5% or 3.6% unemployment. No, I don't. But it's an interesting situation. How do you articulate that?
We could be in. Yeah.
Yeah, that we certainly could be in. Certainly, because we remember back for Q1, our tracking estimate was positive 1.5, and we got negative 1.5 because you can't. The tracking estimates are very difficult to measure what's going on with inventory and trade because that data is lagged and not quite as good. So we were at 1.5 positive. We got negative 1.5. Same deal could happen here. We could get a negative quarter. So we could have 2 quarters of negative growth. So we've got economists and NBER are going to have some explaining to do. Exactly what it means. The other implication is that productivity growth is getting crushed, right? Because productivity growth is output per hour worked. So if you've got people being hired and more hours, but GDP is falling output, then productivity is taking it on the chin, which is not good, but interesting. Okay, fair enough. Let's play the game, the statistics game. Just to remind everyone, this game, each of us put forward a statistic or two. The best, and the rest of us try to figure that out using questioning and guesswork and deductive reasoning. And the best question or the best statistic is one where it's not so easy that we slam dunk everyone gets it quickly, not so hard that no one can get it at all. And bonus if it's related to the topic at hand, which is the labor market, or is it, something that's been released recently over the last week, maybe a couple of weeks. I cheat a little bit every once in a while. You guys are pretty good at sticking to that rule. I'm not quite as good.
Wait,
That's the game.
Did you just admit you cheated?
I didn't say cheat.
collusion.
I said I don't subscribe to the rules as closely as you do. Just, yeah.
Making sure.
Yeah. Hey, by the way, shout out to some of our listeners who are really into this game, the whole cowbell thing. Tim Daly, our colleague, he gave us some cowbells, right? Who's got them now?
He did.
I thought he did. Or
Cris
maybe
has
he's
them.
just taking credit for giving to us and we didn't get them. I don't know. Where are they? Where are these cowbells? Ben, you're gonna have
Got
to
one
figure
right here.
it. Is that from Tim?
Yeah.
Oh,
actually,
there you
you
go.
go.
Very cool.
Even
Look how
has the
cool that
image.
is. That's cool.
Oh man, I look like the guy from what's that show? The scary show. I can't remember the name of it. We're Lurch. What's Lurch? Remember Lurch?
The Addams Family.
Adams Family. We look like we're from the Adams Family.
Got
Can
it.
you ring that
Marissa.
again? Hold it. Can you ring that again? I thought it was a high quality. Okay, that's high quality. That's high quality compared to what Ryan's got. That's high quality.
High quality.
Yeah. Also, I have a good friend VJ. This is a call out to VJ because VJ is a avid listener of the podcast. He gave me a cowbell. I unfortunately I don't have it here. It's the highest quality cowbell. The sound is beautiful. So like it's the kind of cowbell you hear in the Swiss Alps.
Wow.
Yeah, that kind of cowbell. Yeah, really nice. You know what I'm talking about, Marissa? Have you
I
heard
do.
cowbells in
Yeah.
Switzerland? It's just
No, but I can imagine.
oh.
It sounds like the cowbell industry.
I'll
is
have to tell
booming.
you, it's Heidi like. It's Heidi like.
That's what
Y'all-
I'm envisioning. Yeah.
Yeah, it's really nice. He also gave me a Thumper a t-shirt. Thumper, the
Oh,
Thumper
wow.
principle. Yeah, I thought that was really nice of him to do that. So very, very nice.
Good reminder.
Okay, but I need to get my cowbell from the Tim Daly cowbell because that looked pretty cool. All right, who wants to go first? Actually, I'm going to pick. Let's go with Cris first. Cris, what's your statistic?
All right, 13.1 million.
13.1 million. Is it related to the job market?
No.
Ooh, it is not related to the job market.
Yep.
It's not vehicle sales because vehicle sales are south of 13 million.
Oh,
That was 12.9 million, right? Or 12.8.
It is
Wait,
vehicle
it's vehicle sales?
it's total vehicle sales.
What?
12.7 was light vehicles.
Oh, that's really tricky. Oh, so it is vehicle sales.
He got it. He got it.
Mhm.
Hold on, wait. Okay. So light vehicle sales were 12. I thought it was 12.8, but you're saying it was 12.7 million?
12.7.
Okay. And then over total vehicle sales, which includes heavier
trucks.
trucks, that came in at what?
13.1.
That was weak.
That was weak.
was very
Both
weak.
were weak.
Mhm.
Both were very weak.
That's what
Which
hit our
again,
tracking
going back,
estimate.
is the economy strong or weak?
Exactly.
Depends on which part of the element you're touching. That's a weak number, 13.1.
It is. It is. The drop in truck and SUV sales was the largest since March of 2020.
That
Okay,
could
is
be
this?
that's people
Okay.
hesitating
That
because
could
gas
be a
prices
reaction
are
to
through the
gas
roof.
prices.
Oh,
Yeah.
Well, that's
Like
the
I-
question. Is this a supply chain issue? That
yeah.
You can't just build enough, which had been the case, or is it people now changing behavior?
Well, that
And
I
pulling
get
back.
more nervous if you're telling me that's demand. You're saying gas prices are up. Oh, because you're saying it hit the vehicle, heavy vehicles, the gas
Mhm.
guzzlers more.
Yep.
That's an indication that this is about demand.
Right. And there was this nice write up from Michael Brisson on the
Our
economic
colleague.
field. I'll give him a plug. He pulled out this interesting statistic that in terms of expectations of purchasing a vehicle over the next year from the conference board,
Mhm.
56% of people plan to buy a new vehicle within the next 6 months. And that's less than what it was back in May of 2019. So it does seem like people are at least indicating that they are hesitant to buy.
That actually makes me a little nervous. I mean, because the month before we were at almost 15 million, weren't we? In the month of April,
Yeah,
we were
15 million. Yep, 14.9. Yeah.
14.9, and that dropped to 13.1.
Yes.
And we're saying that's not supply chain issues or production, that's demand.
Mhm.
That's a big deal.
Yeah.
If we think that's the case.
I mean, it was 13
What about-
at the end of last year. It dropped as well, but I chalk that up more to the supply chain issues.
Yeah.
Now it seems like demand is the
Okay. All right, does that
significant
make you any
factor.
little more nervous about the question about how the economy is doing?
Well, what about light vehicles? What was the
Yeah. What was like
the change there?
Yeah.
The trajectory look like?
Oh, so similar, right?
Similar.
Light
Yeah.
vehicles also went from 14.5 last month to 12.7 million this month.
I was just wondering if people are substituting, not buying an
Yeah,
SUV. buying
Trading
something
down or
else.
trading
Yeah.
down the less gas guzzling.
Well, the
Mhm.
the drop in autos was smaller than the drop in
Trucks.
light
SUVs.
trucks and SUVs. So
right.
that would suggest that
There is some of
that's the
that
case.
going on.
Although production, I think, is also shifted more towards light trucks and SUVs. So maybe the supply chain effects are larger there as well. So I don't know that we can read too much into that, but it does suggest certainly that people are sensitive to the price of gas and
Yeah. Why?
pulling back one way or the other. So,
Ryan, how do you interpret that? Is that make you any more nervous?
A little
About
bit
the-
more nervous, but I think
more
consumers are
nervous.
just being rational. I mean,
Yeah. I guess it shows they're responding to price
Price.
effects.
Yep.
Yeah. Which is what we need to happen, I guess, to
Yeah,
bring in inflation.
I mean, just my kids play a game when I fill up the car, they try to guess how much it's going to be. And now their guesses are over $100. It was $119 the other day.
Really?
Ooh, ouch.
You got to stop
Mm-hmm.
driving that big van you're driving. What are you
Are you
driving?
still going with the premium?
Oh yeah, that's it. He's buying premium.
Why are you
Wawa
doing that?
premium.
You have to in this. Never mind.
Ah.
I don't want to go down this road.
You have
All right.
to.
Okay. Very good. That was a good statistic. Oh, we didn't hear a cowbell. I mean, Ryan nailed that one.
Yeah.
I did.
right
I
out-
did.
right out of
Yeah.
the
I gave
gate.
it.
Oh, you
Want
did
another
hit
one?
it?
Chris did,
Okay.
yeah.
Oh,
There you go.
beautiful. Well done. Well done. Yeah.
All right.
Okay, Marissa, you're up. What's
Okay,
your statistic?
76.6%.
Is that
Comes from the
related to
employment
This
number?
is job market related.
It is.
the payroll survey or the household survey?
Household.
Okay. 76.6. Is it that's a percent, right?
Mhm.
Yeah.
Not a
so-
growth rate.
Female labor force participation.
He said female labor force
You're
participation.
almost there.
Prime age.
Yes.
Women.
Oh
go.
my God. Oh, way to go, Ryan. Excellent job. Woo. So female labor force participation is 76 point
It's prime age women.
prime age.
25 to 54, 76.6%. That rose over the month, and it's risen quite a bit in the past few months. And now it's only 0.3 of a percentage point away from where it was in February of 2020. And it's actually closer now to the pre-pandemic rate than men's is to their pre-pandemic rate,
Oh,
which we
okay.
hadn't seen in a while. So I thought it was interesting because also if you look at labor market flows, you can look at people moving into the various categories. There was a very large uptick in women coming from out of the labor force into unemployment. So entering the labor force and looking for jobs. And this is a group, right, that was disproportionately hurt during the pandemic. A lot of prime age women left the labor force because somebody had to stay at home with kids who were unable to go to school or daycare. And that still is usually women that have to do that. And that this has represented, I think, a big chunk of labor supply that's been out there. And it's really coming back. And to the point where, we're going to be back to where we were pretty soon, I think.
Yeah, good sign. That's a good sign.
Yeah.
So they also
Are we seeing? Okay.
no, go ahead. Go ahead.
Are we seeing improvement in childcare employment?
gonna ask
Is that
that.
the? Is that driving
That's a
this?
good question. I haven't looked at
Okay.
that.
It stands to reason though, right?
It would stand to reason, yeah.
Well, maybe Ryan, you can take a look and see what happened to employment at childcare centers. I mean,
Yeah, I can take a look.
take a look. Yeah, I'm just
Look.
curious, what happened.
I
there.
mean, and
know
this is based
Okay.
just around here in Chester County. There's long waits to get kids into daycares because they can't find workers.
right. But maybe to
Let me look
suggest
it up.
that some of those constraints are abating in some parts of the country,
Yeah, maybe.
allowing women to go back to work. Yeah. Oh, that's very interesting. So you're saying that the female prime age participation rate has recovered more than the male participation, prime age.
It's
participation
closer, it's now closer to its pre-pandemic
Yeah.
rate than the men's is to theirs by a little
Okay.
bit.
Okay.
Yeah.
Okay. Interesting. Okay. That was a good statistic, and Ryan's on a roll. Now I'm getting a little nervous. Fortunately, he's got to give us the statistic now. What's your statistic, Ryan?
455,000, and this is down from 586,000. But this is a good sign.
This is from the household survey as well.
No comment.
do you
No
mean?
comment.
No comment.
Can't,
What?
no, can't. No, we'll give it away. You guys will jump on this in 2 seconds
it-
if I say.
Is it
It's-
household employment? Oh, I know what it is. I think it's the household employment growth rate put on the payroll survey measure
Definition.
Nope.
definition. No?
Is it,
No.
Okay.
is it marginally attached?
It is not. It's labor supply related.
The labor supply.
Not want a job.
Oh, is it the number of people who weren't working because of the pandemic that are still out because of the pandemic?
Yeah,
They're
I'll
not.
give it to you. That was good. So it's the number of people
I
not
botched
in the labor
the. You know
force.
what I'm saying, though.
Yeah,
right?
it's number of people. 455,000 people were not in the labor force because they were prevented from looking for work because of the pandemic. So this gets back to the idea that labor supply is really critical to future job growth, and this is declining, which is a good sign that more people are able to go out and look for work because the pandemic's kind of fading.
So does that deserve a cowbell? Just saying. No one.
Yeah, Cris has got the cowbell going.
Okay. Well,
Little
okay.
one.
All right. So, okay. I got that. I'm very happy to get that because I'm still trailing Ryan, but feel good about that one. But there's still 455,000 people out there that are not in the labor force because of the pandemic that could
they're
presumably
prevented
come
from
back
looking.
in.
Yep, they're prevented from looking for work because of the pandemic. So that should continue to fall, and that our employment forecast is really sensitive to changes in labor force. So
yeah,
as long as we get more supply, we should go ahead.
What do you think that actually means?
Yeah. Why
that they're
aren't they
prevented from looking for work because of the pandemic? Because these are people not in the labor force. So that means they haven't looked for a job in the past month and they wouldn't or couldn't take one.
Maybe they're still sick. Maybe they're sick.
Does it mean they're sick? Does it mean they're
taking care of sick
temporary
people?
layoff?
Yeah. I even looked at the Pulse survey from Census recently. Have you guys?
I haven't looked at it recently.
I'm not even sure they've released one recently, a survey. We should take a look because that gives it more insight into why people aren't in the labor force.
Survey
for what
fatigue.
reason? Yeah, survey fatigue. That's another good example. Yeah, survey fatigue, taking it and looking at them.
Looking at it. Yeah,
looking at survey fatigue and looking at them.
It's not good for our jobs.
No. We can't get tired of that. Interesting. Okay. Well, that's very good. That was a good one. Okay, I'll give you mine. You ready?
Yep.
$598.50.
Lumber.
Oh, very good.
Oh, Cris, good job.
Cris.
Here, I'll give
that
you
was
a
like
cowbell.
that was flawless. Yeah. Well, actually, I guess that was too easy.
That was good.
That's a good one. That's a good one.
It's come down a lot.
Yeah, I think that's really a big deal, right? Because just for context, at the worst of the lumber shortages back a year ago, it's hard to believe it was a year ago, lumber was going for over $1,600 per board square foot. So we're down to 600. And prior to the pandemic, just before the pandemic hit, it was $450. So we're not quite back to pre-pandemic, but we're pretty darn close, right?
That's falling fast, right?
And falling really fast. And inventories are apparently very, very high. We've got a lot of inventory of lumber now. So it does feel like that. And this is how it's supposed to work, right? The Federal Reserve has raised interest rates and trying to slow the economy's growth rate. It works primarily through financial conditions and the most rate sensitive sectors of the economy, housing, and housing is definitively slowing. And that's now being reflected in lumber prices. So that's kind of a good bellwether for, kind of what's going on in the housing market. And that's not only new construction, that's probably more importantly, repair and remodeling and renovation, going back to those building material supply retailers that are laying off at this point. So it does feel like things are happening the way, at least so far, at least the way they should. We're starting to see some slowing there. And it's having an impact on commodity prices, lumber prices, and that's the first kind of leading edge of a more broader moderation in inflation. It was the commodity prices that kind of led the way, and then we saw inflation pick up more broadly, and now we're starting to see the opposite occur. The exception being oil, obviously related to the Russian invasion and the European Union's decision to sanction the Russian oil that caused oil prices to rise. But it feels like commodity prices are starting to come in, and that's a really good sign.
So the rise in construction workers that we saw in the employment assessment today, do you think that's just a temporary?
I took that as a good sign too. Like more supply, I mean,
okay. They're finally able to hire people.
Yeah, they're finally able. I mean, talk about unfilled positions. They couldn't find people,
Mhm.
and they had all these the properties, these homes in the pipeline for completion or not even started, and they couldn't because they had building material supply issues, but also labor market issues. So my instinct was that that's a good thing, more supply, and that'll help support getting those homes built and taking some of the pressure off of broader inflation. But
Okay.
yeah. Anything else you want to say about the housing market, Cris, while we're on the topic? Because that is clearly on the front lines here with regard to the slowdown. Again, talking about which part of the elephant you're touching. This is a part of the economy that is clearly weakening. Do you want to give us any more color there?
Well, we got a couple other indicators this week from Case-Shiller in terms of home prices, both from Case-Shiller, 20-city composite, and FHFA. The Case-Shiller continues to accelerate. I think it was 20.2% year over year, if I recall.
Yeah.
So even faster than the prior quarter. And then FHFA decelerated a bit, but still, I think right around 19% year over year. So still very, very high. I see that as still as just lagging. We're just, we're looking in the rear view mirror here. Other indications suggest that things are slowing down in terms of listings and activity. So I still expect to see some deceleration, but on the other hand, there's still lots of demand out there. So stick by the forecast that we have in terms of slowing but not collapsing prices in the housing market.
Yeah, I was on a panel for FIAZI, which is like the trade, one of these research trade groups for bond investors, and this is a panel on housing. And Lori Goodman on from Urban Institute, and Ed Pinto from AEI, really good housing economist.
Yep.
And Ed does something interesting. He looks at transactions from Optimal Blue. Optimal Blue is this platform that collects data on housing transactions, and based on that,
Mortgages,
you can see,
right?
Oh, excuse me, on mortgages,
Yeah.
and you can see, what price, what the homes are transacting for, with a little bit of lead, because it reports on Optimal Blue, and then the closing occurs 3 months later. So he's looking at, he can tell us what, based on the properties that are on Optimal Blue, what price growth looks like in July of this year. And it's year over year, 14.7%. So that sounds really high, and it is, but that's rolling over though. That's definitely rolling over. So sequentially, it suggests maybe flat pricing, maybe even down pricing, some markets. And I think we're starting to see that in some of the transaction data we're looking at too, right?
Yes, we are. So it's a very similar pattern to
that
FHFA.
Yeah. Okay. All right. A couple of other topics I want to address before we call it a podcast.
Do you want childcare employment?
Oh yeah. What was that? Yeah.
It was up a little bit more than 1,000 in May
Okay.
to 937,000. Pre-pandemic, it was a little bit north of 1 million. So
Okay.
gap is closing, but very slowly.
Slowly. Huh. Interesting. Okay.
I guess another factor I'm hearing though is that there were a lot of restrictions during COVID in terms of the number of childcare providers you could have, and that those may be relaxed. So you might be getting some relief
That's a good
in
point.
terms of the supply of childcare spots.
I don't understand. What's that? What's that?
Oh, so during the so there's
Yeah.
some rules in terms of how many childcare workers you need or how many children can be supervised by a childcare worker.
Oh, I see.
That it was really restricted during the pandemic. There were lots of restrictions in terms of how many you could have, and could one childcare worker substitute for another shift. They were worried about transmission and all that. But so now it looks as though some of those restrictions are being relaxed. So you might be able to see more spots opening up in childcare centers, even if the employment doesn't accelerate appreciably.
Got it. Okay. All right. Here's something else that's been bothering me. I don't know if you've noticed, but in the last few days, weeks, I hear more CEOs, big name CEOs, coming out and saying, you saw Jamie Dimon, who's the CEO of JP Morgan Chase, the largest financial institution in the U.S., come out and talk about hurricanes dead ahead. I'm paraphrasing, obviously, but it was pretty dark.
Economic hurricanes.
Economic hurricanes. Sorry.
Yeah.
Or economic hurricanes, meaning recession dead ahead. And then you saw Elon Musk, who just said, he's very nervous about the economy and he's going to potential layoffs at Tesla and hiring freezes and that kind of thing. And and of course, this going back to surveys, all the consumer sentiment surveys, not all of them, but like the University of Michigan survey, very, very weak. Business surveys, very weak. The small business survey from the National Federation of Independent Business, very weak. People are very, very pessimistic. Can we cause a recession just because we lose faith that we talk ourselves into recession? Is that a possibility? What do you think, Marisa? Do you have a view on that?
Yeah, I do. I do think that. I think ultimately a recession, as you said, is a crisis of confidence. And if people think we're in a recession or we're imminently headed into a recession, then people will batten down the hatches and stop spending, start saving, put off large purchases, become really circumspect in everything that they're doing. And I think that, that stifling of demand is what ultimately causes a recession. Whether that's manufactured by the Fed or it's exacerbated by what the Fed's doing. If people think, well, I'm not going to buy a car because car prices are up 50% compared to what they were prior to the pandemic. And I'm not going to take out a loan and take on another expense and increase my debt burden if there's a possibility that 6 months, a year from now, I might lose my job or someone in my household might lose a job. Yeah, I think it could. I mean, I think there has to be something fundamental, though, that is also happening in the economy, something real. But I think if enough people are yelling fire, people are going to start running.
Yeah. What do you think, Ryan? Is it in the current context, in the current environment, given everything else going on, do you sense that if we could talk ourselves into this?
I agree with everything Marisa said.
You did. Okay.
Yeah, I think we can definitely talk ourselves into a recession. And I think that's one reason why when the yield curve inverts, you hear everyone saying, "Oh, here comes a recession," is because
you've been saying that a long time. Yeah,
and that you just talk yourself into an economic downturn.
Yeah, Cris.
Yeah, I'd agree. In certain points in the business cycle, I think there is that vulnerability. I think it's hard to say you could talk from a very rip-roaring type of economy and suddenly move the entire economy into recession. To Marisa's point, I think there has to be something else out there. But we do have plenty of fissures here, potential cracks in the pavement that could be exacerbated by confidence and psychology here. So yeah, I think we're vulnerable. But.
There might be another take on it. And that is, this is exactly what you'd want to see. You want CEOs saying this. I mean, at this point, right? Because you want the economy's growth rate to slow. Yep. You want less job growth. You want because otherwise we're going to blow past full employment and inflation is going to become more endemic. So we need business people to hire less, right? And, layoffs are incredibly low. You saw the initial claims for unemployment insurance, 200K.
Yeah.
That's not consistent, I don't think, with stable unemployment, right? You need something closer. Cris, your benchmark has always been 250, I believe,
yeah.
Right? 250K. Yeah. So we need to see slowing. And that means that you would expect some CEOs to say, hey, I'm nervous. I got to be more cautious, right? So the fact that Jamie Dimon and Elon Musk and a few others are out there, talking about this, maybe that's exactly what needs to happen to get to where we need to go. No?
The risk is that it's hyperbole, right? That it's one thing to say, I'm worried about slowing, to your point, and therefore we're going to, take some steps. We're not going to be as aggressive in our investment plans, whatever, but hurricane and some of the other language seems as though it's imminent, that it's, there's nothing we can do. It's coming.
Well, that's the other weird thing. I mean, when you talk like that, it's like recession is like next month, this summer, maybe the fall. But very few economists, even the ones calling for a recession, would say that, right?
Right,
They would. They're
right.
saying next year.
Next year.
You like Ryan, you're saying next year,
Mhm.
right? So that, yeah. So, okay. Yeah, I mean, I, at the end of the day, a recession is a loss of faith. So, people run for the bunker. The other point though is no one's running for the bunker yet, right? Because a good benchmark of running for the bunker is the saving rate, the personal saving rate, right? If you're running for the bunker, that means you stop spending, saving goes up, right? But right now we're seeing saving rates go down, right? So that's not consistent at all with the idea. Yeah, consumers they're upset, they're nervous, they're pessimistic. They don't like the inflation, understandably so, but it's not like they're acting based on that. They're acting just the opposite, right? Vehicle sales is the exception, I guess, but we saw, personal saving rates decline.
Other discretionary spending is up, right? Travel,
Yeah,
restaurant,
exactly.
right? So there's
all very
it's not
strong.
like people are not spending.
Right. Right. Okay. All right. In terms of this idea of that we can talk ourselves into it and sentiment, is there, the one measure I look at to gauge that, the one I find the best, most useful, is the Conference Board survey of consumer confidence, because that's more labor market oriented, and that goes to the job market. And I think that's, more dollars and cents and what people ultimately do in terms of their spending and saving behavior. Do you guys have a favorite statistic, or is there other statistics you look at to gauge this sentiment, whether we are losing faith? Anything in particular? You may not. I'm just asking if there's anything else you look at. Ryan,
I look at the Conference Board.
You do look at
but I think it's important to mention that the relationship and the causal relationship between confidence and spending is very loose in the short run. So consumers can be, down in the dumps, but they're going to keep spending like we've seen over the last few months. So it doesn't mean when confidence drops that, you're automatically going to see spending just tank. So because the Michigan survey, that's gasoline prices, that's the stock market. So that one, I'm not surprised is falling very quickly.
Right. Okay. Cris, Marisa, any measures you look at?
I've actually come to rely less and less on the
sentiment measures,
on the sentiment survey. I guess we've been talking surveys. I think that's definitely the case. And I've mentioned the political differences as well. That just makes me believe that those surveys aren't really capturing underlying sentiment, perhaps of consumer. There are a lot of other factors that people are using to when they answer there. So I tend to rely much more on the harder data, right? Whether it's market movements or spending itself, right? That ultimately is the true test of confidence. Right?
All right.
I'll give you an unusual one.
Okay.
I look at Google Trends for recession. So if people are searching Google for, what is a recession or recession, then they're really thinking about it and it's on their mind and it's likely affecting their behavior. So I look at a lot of Google Trends search data.
And what does that look like right now?
It's gone up. Yeah, but I mean, it's not surprising. I mean, it's not to the point where you'd be like, oh, well, there's a problem, because, now you can't read a news article or turn on the TV without, someone mentioning Jamie Dimon, for example, saying recession. So there could be some groupthink coming in.
I've got another one for you. It's not exactly sentiment, but kind of sort of is. It's how much people sell their plasma for money. That you can go donate plasma or you can sell plasma, and you got companies that buy the plasma. In fact, don't ask me how I know all this stuff, but I from a reliable.
I know it too.
Yeah. Apparently, the U.S. is the largest source of plasma in the world. About 75% of all plasma comes from the United States, because in the emerging world, they're very nervous about allowing people to sell plasma for, I think obvious reasons. So we are the predominant source, and in good times, people don't sell their plasma as much, but in difficult times they do. And that's picked up quite a bit since the beginning of the year. A lot more people selling plasma, which is, an indicator that maybe things are, starting to go off the rails here a little bit. So just another reason to be a little nervous.
It's your Greenspan
men's underwear indicator. Yeah, exactly. Okay, I want to do two more things before we call it a podcast.
Mhm.
First is, and we can speed this up a little bit. First is I want each of you to give me one indicator that you're looking at that is really most upbeat and most downbeat, things that, because there's so many cross currents going on. What indicator is really saying, hey, things look really good, and what indicator is saying, hey, things really look bad. And then we're going to end by each of us giving our recession odds for the next 12 months and the next 24 months. And each of these podcasts we do going forward, I want to do this for each of them going forward and see how that changes over time. If we're to let the listener know, how our thinking, bottom line, how's our thinking changing around recession risks? Does that sound reasonable?
Mm-hmm.
Okay. All right. Cris, can I begin with you? Do you want to give me a up indicator, down indicator in your recession odds?
Sure. So up indicator we've been talking about all day. It's job market.
Job
Right.
market, jobs.
Yeah.
Okay.
Jobs, unemployment rate, employment
Okay.
population ratio, whatever you like.
Okay.
They're all
Yeah.
saying very healthy situation here. There's plenty of negatives, but probably real income itself, just inflation
Real
adjusted
wages.
incomes,
Yeah,
real
real-
wages.
real-
Exactly.
yeah. So that's nominal wage growth of 5% less the inflation rate of 8%. So real wages are -3, something like
Right.
that. Yeah,
That's
okay.
right. So that's certainly
Very negative.
negative. And then my recession odds haven't changed all that much, but maybe a shade higher. I think it was at 55. Now I'm closer to 60% by the end of 2023. I think that's
Wait a second. So
Wow.
next 12 months is what's your recession odds?
next 12 months.
Yeah.
Oh, I thought you were going through the end of 23.
No, well,
12
would it be
months,
okay if we
okay.
do next 12 and next 24? I think that's just easier to get our minds around.
Okay. Next 12, probably closer to 40%.
40%, 40.
40.
Ben, are you writing this down? You got to write this down. 40. Okay, go ahead. Ben is our producer and he's listening in. Presumably he's listening in. Yeah. He actually is listening. He's a very good producer. Go ahead.
Yes, I'm listening, Mark. I'm here.
There you go. I was
There
waiting
it
for
is.
that. There's Ben.
And behind the curtain.
And
And I'll go 60% in 24.
Okay, 40% recession odds in the next 12 months, 60% in the next 24 months.
Yeah.
Okay. All right. Very good. Marisa, you want to go next? You're
Sure.
up, down, all around indicator?
So indicator that tells me things are really good is unemployment insurance claims. I mean, it had been like edging a little bit higher until this past week, but I mean, they're still incredibly low, and it's a good leading indicator, right, for a weakening job market when you start to see layoffs pick up. So there's just no sign that, as you said, it's hard to talk about an imminent recession when you have an unemployment rate that's 3.6% moving lower and jobless claims that low.
Right.
Something that doesn't look good. I don't know. We already mentioned them. I think vehicle sales, just because that is such a huge chunk of consumer spending and it can really move the needle on overall GDP growth. And it's also, I think, something that people plan for generally, right? So it does kind of give you some insight into consumers and what they're thinking, let's say several months, a year out in terms of their own large scale spending.
Yep.
I mean, I'm not hugely convicted on that just because there are these supply chain issues that are kind of still messing with behavior. So, I mean, I do think that appears to be abating, but vehicle sales are pretty big in terms of consumer spending. So I'll say that. Okay, recession odds in the next year, I'd put at 33%.
33. Okay.
Yeah. In the next 2 years.
Yeah.
50.
50%. Okay. Yeah. Okay. Very good. And Ryan, what's your up and down and recession odds?
All right, one indicator that points up is the quits. So a lot of people are still quitting their job, and normally you don't quit your job if you're, worried about your your employment situation in the near term. So I think that's an encouraging sign. Down, I would say, kind of similar to Chris's, real disposable income, and real disposable income is what matters for consumer spending. That's dropping like a stone, and that's a lot of it's inflation related, but that's an issue.
Yeah. And your recession odds?
All right, next 12 months, I would say 45%. Next 2 years, 80%.
Oh, you've gone up.
Gone up.
Wow.
2 years. That's 24 months. A lot
Yeah,
can go
that's a
wrong
long
in 24
time.
months.
No,
Yeah.
you're right. That's a long time. Yeah. The odds would be high regardless. I mean,
Yeah, just
actually,
in
if
the
it's
next 12 months, I just don't see that's a short horizon. So I think it's hard to see a recession by June of next year.
well, you said 40%. That's pretty high
Yeah,
for the next 12 months.
Starting
Yeah,
in the next one.
starting in the next 12
Oh,
months,
okay.
it's 40%. Yeah.
Yeah. Well, am I right? I mean, given the lengths of business cycles, historically, the typical odds of a recession in a given year on average would be close to 15%, right?
Yeah.
So 2 years out, you can kind of do the arithmetic. It's
Right.
not even if it's typical, the recession odds would be pretty high. Okay.
Mhm.
All right. Okay. I'd say on the upside, excess savings. We have
Good
a
one.
lot of excess cash, 2.5 trillion by our count. Even with it peaked at 2.6, it came in because saving rates have come down, and people are now having to shell out more of their excess cash to meet the higher gas prices, food prices, and inflation. So it's down, but 2.5 trillion, that's a lot of cash, right? I mean, that's over 10% of GDP. And yes, most of it is sitting with high income households, but it's pretty much across the board. So low income, middle income, high income. So that makes me feel that feels like a pretty significant cushion, right? For a lot of bad stuff that could happen. Consumers keep on spending. So I'd keep an eye on that. We should continue to watch that very carefully. And by the way, we are going to get an estimate for Q1 of excess saving by income group in the next week or so. We'll get all the data we need to do that. So that'll be very telling, with what's going on with excess saving among low income groups, because that would be the most vulnerable group here, obviously, given what's going on with inflation.
I don't think they have that buffer. I mean, they're borrowing aggressively now. Personal loans.
By our estimate, through the fourth quarter they did. They still had a lot of excess saving.
Yeah, I think since then they've blown through.
Yeah. Well, how could they? We went from 2.6 to 2.5. Even if all of that came out of low income households, they still have excess saving. Not as much, but they still do. I guess you're saying you don't believe the data, our data, the way we constructed the data.
Maybe.
Yeah. Yeah, I don't know.
It's not consistent with some of those other data points I'm seeing.
You mean the increase in credit card outstanding,
credit card, personal loans.
Yeah,
but can that be just transaction and
related.
gas? Yeah, it's just transaction demand. I'm traveling more, so I'm putting more on my card.
That's at the higher end. Sure. I believe that, but not at the lower end. I think that's they're going to credit because they can't.
Well, and I thought if you look at our data, because this goes to the Fed's data, which I thought we figured out was bogus because of bad seasonals. If you look at our data based on credit files from Equifax, it's increasing, but didn't feel like it was like an untoward amount of borrowing. Did I have that wrong?
Personal loan is growing very fast at the bottom end. Well, there we have it by credit score. So it's not perfectly aligned, but the lowest credit score bands are increasing their balances very quickly.
Let's talk about that in next podcast.
Okay.
I'm more curious about that. Yeah. We'll take a closer look at that. And on the downside, gasoline prices, holy cow. We're headed towards $5 a gallon now. Price of oil is at $1.17 per barrel. I think we're right on the edge of what's tolerable. If it goes much higher, we get over consistently over $5 a gallon nationwide. That means I was out in California, what are you paying out there, Marissa? I don't know.
Well, I just noticed it jumped 20 cents just in one day yesterday. So I paid $6.08 2 days ago, and now it's $6.30
6.30 as of yesterday. And gas prices play such an outsized role. Going back to, can we talk ourselves into a recession?
Yeah.
I mean, that is really. In fact, I don't drive much at all now, but I did fill up my gas tank the other day. When I only need half a tank, but I filled it up. The woman across the way was just going on and on about, you're right, $100 to fill a gas tank. That is like, that resonates with people. That really makes them, I got to pay $100 to fill my gas tank, that. So I think that's a key indicator to watch here. If that keeps moving up, that.
Do you have a threshold of what gasoline prices would be to cause a recession?
I think it's got to be at least 5. Probably if it's nationwide closing on 6, that means that that means that oil prices are probably closing on 150 a barrel. I think we're toast at that point. I don't see any way out. So you can see why the president's going to Saudi Arabia, get those guys to pump more oil, because, we need more oil to get and the other thing is, interestingly enough, oil consumption is actually coming in. There's some demand destruction because of the higher price. People are traveling less. In fact, we consume about 20 million barrels here in the U.S., 20 million barrels a day of oil. That it's come down about 1 million barrels almost from where it should be because of the higher oil prices. And that goes back to the vehicle sales that we were talking about earlier. So, I think that's a really critical variable. Okay, so recession odds, they have not changed for me. 1/3 probability over the next 12 months, and close to even odds, not quite, over the next 24. So that's about where I've been. I will end by saying I haven't changed my recession odds, but I am more optimistic today about recession prospects than I was 6-8 weeks ago. And the reason is that the Fed has been successful in nailing down inflation expectations. They're tough talk, and they're half-point move on interest rates, and what Lael Brainerd said yesterday about no pause in September, that has worked. Inflation expectations, at least as measured in the bond market, which I think is the most valid, important way of looking at it, have come in, and they're consistent with what the Fed is saying. And that makes it much more likely that the Fed will actually succeed in bringing inflation down close to something that we're more comfortable with. So we have the green arrows up there as the risks to our risks. So I think there's a lot of risk out there, but it feels a little less risky to me today than just the opposite of Ryan. Ryan went up on his recession. Okay, Ben copied those down. We're going to come back to this, if not every week, every so often, because I think that's a good way of gauging our collective thinking around how things are going here. Okay, with that, we're going to call it a podcast. Just a couple of reminders. One, at Mark Sandy, and obviously Twitter handle. Please follow me. And Ryan, what's your Twitter handle?
At realtime_econ.
Okay, there you go. Marisa, do you have a Twitter handle? I think I asked that before. No.
Yeah, but I don't tweet.
Oh yeah, you follow. You're following both of us
I
religiously.
am.
You are very good. And Dr. Dorides has his LinkedIn page. I know that's a happening place. At least I've heard that. Please give us a rating. We need ratings on our podcast. That really is helpful. Any ideas for future podcasts? Please, you can tweet them at us. Tweet ideas.
We have a survey.
You can fill out another survey on economy.com. Go to economy.com if you're not completely fatigued out here. Oh, and I did want to mention we have a number of great guests coming on. We have Sheila Bair. She was the former head of the FDIC during the financial crisis. And actually, just a sidebar, I think she did the single most important step during the crisis to bring an end to the crisis. So I'm not going to tell you what that is. You got to come to the podcast to listen to what that is. We have Julia Coronado. Julia is a great macroeconomist, formerly of the Fed, has her own firm, and is out there quite a bit, and be good to have her on. And Anna Stansbury, she's a academic professor from MIT. Is that right, Cris? I think she's from MIT. And she has a lot to say about women in economics. And, obviously the economics community has not been all that great about getting female participation. So I want to talk to her about what's going on there and what can be done about it. So with that, we're going to call it a podcast. Thank you, everyone.